It's just going to cut straight to zero. It's not even going to be during a scheduled FOMC meeting. It's just going to be overnight, and then the market's going to wake up the next day and understand that the Fed did this because of an emergency, and the stock prices are going to go all kinds of crazy, and gold's going to go even crazier, and silver crazier still.
This is Kaiser Johnson, and these are the Miles Franklin Weekly Specials for September 9th through September 16th, 2024, while supplies last. First, we have a very limited supply of backdated silver Australian Kookaburra 10-ounce coins at just $3.10 over spot per ounce. Next, 1-ounce backdated platinum maple leaves are just $80 over spot. And finally, we have compelling pricing on various pre-33 American gold coins. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Rafi Farber from the Endgame Investor. Rafi, thank you so much for joining us today.
Good to be back again, Elijah.
Well, it's great to have you, especially as we're seeing gold really skyrocket the last couple of days. So your perspective of this new all-time high we're seeing right below 2,600 and really what it means for the gold market.
Well, what it means the dollar is dying, thank God. With all the damage that dollar spenders, the main dollar spenders, of course, the federal government, with all the money that they're spending all over the place destroying things. There's a lot of collateral damage to the death of the dollar, and we're part of it because we spend them and we use them. But, we can adapt. We can adapt, and the U.S. government can't because that's their main resource supply, is the fact that the world accepts U.S. dollars. But, as for the gold market itself, it's pretty surprising that gold continues higher here, even though, and this is going to sound a little bit maybe heterodox or contradictory, but it's how things actually are supposed to work. Even though more money keeps entering the system, and the money supply is still much higher than it would otherwise be had the 2020 and 2021 printing not happened, which means that the stimulus effect should still be here. Even though we're at that stage, gold is still going up to new all-time record highs. I mean, it shouldn't be that way. The gold should really only be at all-time record highs immediately after an inflationary spurt, right? Not in the months and years afterwards when, the stocks start going up and other derivatives start going up. So money starts leaving gold, leaving the safe haven, chasing the momentum. But we're not seeing that now. We're seeing the momentum starting to die off, and gold hitting record highs. I mean, think about what happened in the last bull and then bear market. The bull market lasted until 2011, and there was a bear market in 2015. So you had this QE 1, 2, 3, right? And then gold hit record highs in 2011. And then we had like a 4-year bear market as money started to flow out of gold. There was less of a panic about the dollar, and then they went into these risk assets again. We had a little bit of that into 2022, but gold hit a low of like 1610 and then didn't go below that. So we're seeing sort of a repeat of we saw a little bit of a repeat of the 2011 to 2015 bear market, but it really wasn't much. It was nothing compared to what we went through. I don't know if you were actively investing in gold back then in 2011 to 2015, but I was, and I was much younger. I had a lot less capital. I was just starting out, but I was still in an end game mentality. I was very naive, but I didn't know it could last this long. But I remember going through 2015 and like waking up nauseous and like realizing that my portfolio was like cut in half or even like 40% of what it once was. And I was trying to convince my wife, like, we were right. I'm right about this. We just have to get through it. And I got through it, thank God, but it was very difficult. This one, it wasn't much. Like, okay, 2022 went down to 1610. Okay, my 4 is not doing so well, but whatever. It didn't really matter that much. So it's much easier this time. And we're gonna go much higher once the next inflation round starts, and we could talk about that too. But I'm pretty just bottom line, I'm pretty surprised we're at all-time highs in this situation right now. I thought we would be lower, and the fact that we're at all-time highs means we have a we have a long way to go when the next inflation round starts.
Now, you've made a few videos recently about possible gold short squeeze, and also you just in the last couple of days analyzed the gold open interest, showing that actually more shorts are piling in right now. So, your perspective on where that could lead in the future.
So first, I just want to discuss for a minute the concept of a gold short squeeze. This can be construed as like a cheap subject. Because people say short squeeze, and then we think of like Volkswagen, or that's the short squeeze that comes to mind now. That was like in the late 90s or something. These short squeezes where we like see a sudden vertical line as shorts close. Oh, we could talk about nickel, the nickel short squeeze. Um, and then people turn off and they say, "Oh, another gold bug's talking about a short squeeze, never going to happen." I understand that. I get that point, because theoretically. And this could be true. I mean, I'm not, I don't examine banks' balance sheets from the auditor perspective, so I don't know what they're actually lying about. But for every contract that a bullion bank is short in New York, they're supposed to be long a contract in London, right? They're not supposed to gamble on it. It's not that they're placing a bet on the price of gold, and a bank like JP Morgan is saying, "Well, I think gold's going to go down the next month, so I'm going to open a short contract." They're not. That's not what they're doing. They're called swaps, meaning they swap gold from New York to London. They go short in New York and they go long in London. And then if a client stands for delivery, they just deliver the gold or they do an exchange for physical from the position in New York to the position in London, and they're not really technically risking anything. However, so when we talk about short squeeze, why is it even worth talking about then? Because maybe they're not. We don't really know what they're doing and who really owns the gold in London. And you can come up with all these theories on who owns what, but the fact is nobody really knows. Probably not even the bank knows. So what I'm basically talking about is that the amount of contracts net that these swaps, the ones that are supposed to be short in New York and long in London, supposed to be, they're record short. They have the record amount of contracts that they're selling short. And obviously somebody has to sell short in order for somebody else to go long, right? You can't go long off of nothing. So somebody's got to sell the contract. So they sell the contract and they provide the liquidity in the market. That's what they're supposed to do. They're short like something like 250,000 contracts, maybe a little more. And that's what, like 2.25 million. What's 250 times 100? 250,000 times 100, that's 25 million ounces. Does that even exist in London? I don't think it does. So something's off here. And the fact that open interest went up last week, and it went up about 40,000 contracts, and the price of gold went up with it, that's normal. The price is supposed to go up with open interest. But at all-time highs, it means that the bullion banks are opening these new short contracts at the all-time highs. Now, if we're going to see a short squeeze, at least on the New York side, what we should see is falling open interest with a rising gold price. We almost never see that, which tells you that at least theoretically they are balanced. They're short New York, long London, because they're not pressured. So they wait for the price to fall, and then for people to either book their profits or whatever they're doing, and then they exchange the contracts. But if we did see one time falling open interest and a rising price, and that was into the 2011 top in September 2011. For about 2 or 3 months, we saw it. Falling open interest, rising gold price. We're not seeing that yet. If we start seeing that, then we can say it's a short squeeze. I don't know if that means they're going to default in London. I'm not making like apocalyptic predictions here to say that the monetary system is going to die on a short squeeze. I don't think so, because I think it's mostly a fiction. It's going to die in the streets, in the supermarkets in the United States. That's where it's going to die. That's where gold's going to go to infinity. But this could be a sign that we're going in that direction. So watch open interest. If the open interest goes down and price goes up, Then we're on a New York size short squeeze. And what that does to the bullion banks, frankly, I don't really know. Got to be honest.
It definitely will be interesting to see. And we haven't ever been at these prices before, so it's kind of new territory in some respect. But obviously, we can learn from what has happened in the past. So, if we also look at silver, though, we're also above $30 again. A lot of people have talked about a silver short squeeze. Do you see a potential for that at these levels, or what do you think has to happen before we see much higher silver prices from here?
Well, so silver short squeeze, if you're referring to futures, first of all, let's just like reframe what a short squeeze is in terms of gold and silver, right? If you're long the dollar, if you have dollars in your bank account, I know this might seem like an academic or philosophical point. I guess it is, but it's something I had to keep in mind. If you own dollars, then you are short silver and gold. Okay. That's just to get a floor here on what we're talking about. Because if you own what are dollars originally? Dollars are a substitute or a derivative of originally the silver and the gold that people stored in the banks in order to get the dollars to spend them. Right. So once you own a dollar, you are by definition short silver. You've already sold it to a bank and now it's sitting somewhere in a coin shop. Some how the silver got there is through some chain and now it's there, and now you have the dollar. It's been generations later. Essentially, that's the final short squeeze in silver is going to be the silver parabola up to the 15-to-1 ratio, whatever the dollar amount that's going to be. I don't know. Um, so I have noticed that the open interest in silver futures, if we're going to narrow down the discussion from philosophy to actually practical, what's going on in the futures market now, um, the open interest, if I remember correctly, has gone down since May from 190,000 contracts, which is pretty high for silver, to I think now it's like 130. Maybe it's a little higher now. Maybe it's like 135, depending on what happens today and yesterday. I didn't check it. But say about 60,000 contracts down since May. That's about a third of closed. And the price is the same. It was close to $30. Maybe it was like 27, 28 in May, something like that. And now it's 30. I mean, I hope I'm right about that. I don't track it every day or know which month what price it was exactly. But we're essentially we're at 30 again, and open interest is reset lower, which means that there's a lot of fuel in the futures market for speculators to establish long positions at these prices and bring open interest up again. So I don't know when when the rally is going to start from 30 to say 50 or when that really shot is going to be. I think it's going to be quick. Maybe there's going to be like a stop at 40, but like once we pass 30 and we're comfortably above it, I think the trip to 50 is going to take, a matter of months or less. Um, so I'm saying we have a lot of fuel whenever it starts. It's going to be quick after that, but we could hang around here for a while. And we have about, let's say, 60,000 contracts of space to move up here. So it's pretty exciting.
Now, another topic you've been talking about recently is the reverse repo market. And we've talked about this multiple times, but it is important to keep getting updates on this because it could have big implications for the banking system. You've recently noted that by the end of October at current rates, the reverse repo should really be drained to zero. So your perspective on that and how it could impact bank reserves.
Yeah. So it's important to understand the train of money here. When the Federal Reserve shrinks its balance sheet, it gathers dollars in from whatever parts of the economy to buy, and then the debt that's on its balance sheet, whatever treasuries it is, gets repaid to the Fed. The Fed doesn't reinvest the dollars. The dollars come from wherever, from whoever owns the other side of the treasuries. Essentially the government, right? They're paying it back, but the government gets the money from taxpayers, right? It's vacuumed up through the federal government to the Fed. The Fed takes it out of existence, and then what happens is the government issues a T-bill, right? A short-term treasury bill for dollars that comes from the reverse repos that are earning 5.3% back at the Fed. So there's like this store of money at the Fed while the Fed is sucking dollars out of existence from the Treasury to the Fed out of existence. They're putting money from the reverse repos back to the Treasury, right? When the Treasury sells a T-bill, and that money in the Treasury goes and spreads out throughout the world on whatever the government decides to spend money on. So really, it's like money's being vacuumed out of the banking system and then being shoved back into the banking system through the same Treasury mechanism to the reverse repos. So then the question, we have this circle going on, this like drain going on, but it keeps being refilled by the reverse repos in the same direction. So the question is like, what happens when there's no more reverse repos? Where are the other dollars going to come from? Right? They've got to come from something. You can't just like the Treasury can't just sell a T-bill and then have dollars come into existence to buy that T-bill unless the Fed's doing it. But the Fed can't do that directly. And they're not, and they're still shrinking their balance sheet. QT is still ongoing. It's at a slower pace, but it's still ongoing. So where do those dollars come from? The answer is they got to come from bank reserves. But bank reserves are being used up by what? They're being used up by repos, because you have all these speculators that are using this repurchase cash. That, like, just take a step back. If there's repos going on, right, that banks are trading treasuries that they have on their balance sheet for cash that they need for the night. If that's happening, that means that a lot of banks are short cash. Otherwise, they wouldn't be borrowing cash overnight, right? Why would you need to do that? You're going to pay, what are their rates? 5.3, 5.35% for cash that you don't need? Well, either they're borrowing it because somebody else is borrowing it from them for the night to like satisfy some contract that they're short. Maybe it's treasuries itself. Or the bank is short cash and they need to borrow the money. So the current repo volume is like 2.2 trillion a night. It fluctuates wildly between like 2 trillion and 2.4 trillion lately, like $400 billion a night. Then where's this stuff going to come from if there's no more reverse repos? It's going to come from the bank reserves, and there's not enough money there because like 70% of it's being used for repos already. And once you get too high, then there's going to be a repocalypse, meaning the interest rates, the overnight interest rates between banks are going to rise to like 10%, just like they did 5 years ago tomorrow. So this is going to happen when the reverse repos run out, and we're down, I think today 45 billion. I predicted this that we're going to be around 240 billion. I think I even used that number on Endgame Investor that I wrote this morning, because I just saw that today was corporate tax day, so all the corporations are sending their tax money into the Treasury, and that money comes from reserves and it goes into the Treasury's account, and then they spend it back in. So we're down about 45 billion. There's 240 billion left, 239 billion. It should take, I don't know, 6 to 8 weeks. The pace could always change. It could be November. It could even be December. I've been wrong about it before. It doesn't really matter when. The trajectory is down. It's going to continue down until the Fed reverses QT to QE again. And that's what's going to skyrocket gold. There's going to be some kind of crisis that's going to trigger it. It's not going to be like, oh, I think we're going to calmly pivot now. There's no calmness. It's always sudden.
There is speculation about large rate cut from the Fed coming soon. Your perspective on that and how the Fed might react? It sounds like they might pivot wildly if we start seeing issues in the banking system. Is your take?
Yeah, I think the whole discussion, is it going to be 25 basis points? Is it going to be 50 basis? Doesn't matter. Doesn't matter what it's going to be. Of course, it'll have different short-term effects. Like, okay, so if you own a short-term option on gold, maybe you'll make more money if there's a 50 basis point cut rather than a 25. I don't play that game. I don't care. And really, I don't suggest anybody should care, because it's a dangerous game, and it's just dopamine injections. And I don't want that in my brain. I want to stay calm. I want to stay level. So look, what's going to happen is there's going to be an accident, and it's going to be serious. It's going to be like the apocalypse 5 years ago, or it's going to be something similar but slightly different. Whatever it's going to be, it's going to be. But it's a mathematical certainty, because all of these institutions need trillions of dollars, and the amount of dollars that are available keep shrinking. So eventually you hit a wall, and that wall causes a domino effect. So when that happens, whenever it does, probably sometime shortly after reverse repos fall to zero, then you're going to see a cut back down to zero. in short-term rates. They're going to cut straight back down to zero, just like they did in 2020, just like they basically did in 2008. 2008 took a little bit longer, maybe. I don't know how many months exactly, but it was basically down to zero. This time it's going to be one cut to zero. And it's probably not even going to be at a scheduled FOMC press release, conference, decision board, whatever. It's not going to be that. It's going to be in the middle of the night in an emergency meeting because of something that happened, and it's going to be sudden, and then the market's going to wake up the next day and understand that the Fed did this because of an emergency, and the stock prices are going to go all kinds of crazy, and gold's going to go even crazier, and silver crazier still.
Well, Rafi, really appreciate your time today and your insights as always. I think it's important to remind our viewers to kind of these kinds of discussions help us to understand that it's important to have some of our funds, at least in my opinion, outside of the financial system. If you could speak a little bit to that, and then also your Substack channel, The Endgame Investor, we'll put a link to in the description to that. Can you share with our viewers what they'll find there and kind of it's along the line of, preparing for the worst case scenario, getting your funds outside of the banking system?
Yeah. So about getting your funds outside of the banking system, right? One of the apocalyptic views that I try to counter, right? People might see me as apocalyptic. I'm actually anti-apocalyptic. I think everything's going to turn out fine as long as you understand what's going on. I'm not saying everything's going to be perfect, that everyone's going to survive this, but I think humanity will be fine. I think we'll be okay as a species. We'll be okay as a planet. Things will be better when this is over. But one of the things I try to counter is that people say, oh, well, if what you're saying is true, the dollar really collapses, then, nobody's going to be trading. There's going to be no money, and it's going to be everyone for himself, and we're all going to shoot each other in this, apocalyptic Mad Max kind of world. No, we're not, because when the dollar dies, what people are going to have to do is find the next most liquid commodity that isn't the dollar, because that's where the value is going to be. And we will very quickly go right back into monetary exchange. And the faster us stackers spend our money into the economy, the more lives we will save. Right? We're not going to break down into a jungle, everybody eating everybody. It's not going to happen. We're going to go back to money, because essentially, as messed up as we all are now, because of everything that government has done to us to disturb our perception of reality to such a point that it seems like the entire world is an insane asylum. When they go away, we will very quickly gain our sanity back. Right? It'll be okay. And that's why you have to keep your money outside, your real money outside the financial system, so that it doesn't go down with it. So that you have money after the financial system is done to spend real money, to spend into a real economy, so you can get real things and help real people build real stuff, right? And get back to reality, because we're all in the clouds right now. And we feel it. Like I still get confused with what's real. Like I see a piece of news. Is that real? Is that a lie? Did Trump really get shot again? I have no idea. I don't know what's going on. This call would just be a story to distract me. I don't know, but I know that once this is all over, they're going to stop the lies, because lies cost money and they don't have any money to spend. This is what I talk about in the Endgame Investor. The idea of what I do is to bring people back down to earth, including myself. Really, it's about bringing myself back to earth and focusing myself. And you could just listen to my thoughts. But I try to bring everything down to very logical, basic principles, so that everything makes sense from a deductive standpoint, so that whatever happens in the market, you can see it within the framework of what must logically happen in the end, and you're not really shaken by anything that's going on, unless you're crazy enough to be leveraged, which I highly recommend against. So staying grounded, staying sane, staying physical. Which partly is keep some of your money outside the financial system, and just stay calm. That's my point.
Fantastic. Well, Rafi, we really appreciate your time as always. Thank you so much, and you have a great rest of your week, and God bless.
You too.
This is Kaiser Johnson, and these are the Miles Franklin Weekly Specials for September 9th through September 16th, 2024, while supplies last. First, we have a very limited supply of backdated silver Australian Kookaburra 10-ounce coins at just $3.10 over spot per ounce. Next, 1-ounce backdated platinum maple leaves are just $80 over spot. And finally, we have compelling pricing on various pre-33 American gold coins. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.